All right, let's jump right in. Today we're tackling a huge question. What does a safe investment actually look like in 2026? Because the old rulebook, the one investors have relied on for decades, it's pretty much being tossed out the window. So let me ask you this directly, and I want you to really think about it. Is your portfolio built for what's coming next? Or is it still stuck playing by the rules of an economy that, well, might not really exist anymore? But hey, it's not all chaos. A new playbook is taking shape. So over the next few minutes, we're going to break down exactly what's shifted and what the new rules are for playing defense with your money in 2026. Okay, so to really get why the rules are changing so dramatically, we first need to get a super clear picture of the old playbook. You have to know where you've been to understand where we're going. These are the ideas that shaped portfolios for generations. It all used to boil down to this classic split. On one hand, you had your cyclical stocks, the exciting, high-growth stuff in tech or retail that just takes off when the economy's booming. And on the other side, you had your defensive stocks, the companies selling things we always need, like food, medicine, and electricity. They were your stable, slow and steady players for when things got rocky. So how did we measure this risk? Well, that's where this term beta comes in. It sounds kind of nerdy, but all it really is a simple score for how volatile a stock is. A beta below 1 means it's less volatile than the overall market. That's your classic defensive stock. A beta above 1, well, that's your more volatile cyclical play. And for a very long time, this worked like a charm. Just look at this data. Between 1960 and 2019, consumer staples was the only sector to average a positive return during recessions. A positive return. Utilities and healthcare did their job too, protecting your money way better than high flyers like tech. This was the gospel. But here's the thing. That playbook was written for a totally different game. The economy of 2026 has these powerful new forces at play, and they're scrambling all those old, reliable patterns. We're looking at a trio of absolute game changers. First, the AI revolution is unleashing a tidal wave of spending. It's not just hype. Second, you have this massive fire hose of government money, like the IOBB, pumping billions into the system. And third, inflation has been incredibly sticky. Like gum on your shoe, it just won't go away. And all of this is happening while the storm clouds of a potential recession are gathering. JP Morgan is putting the odds at 35%. That's more than a 1 in 3 chance, which is definitely high enough that you need to be thinking seriously about how to find true protection for your portfolio. So this is what makes things so tricky right now. The signals are completely mixed. We're seeing forecasts for slowing economic growth, but at the same time, corporate profits are expected to be fantastic. The Fed is talking about cutting rates, but inflation is still running way too hot. It's like the economy's GPS is telling you to turn left and right at the same time. And if you want to see this confusion in action, look no further than the one sector that used to be the definition of safety: utilities. What's happening here is the single best case study for how the new economy is breaking all the old rules. Yeah, for as long as anyone can remember, utilities were, well, they were boring. And that was their superpower. They were these steady yield plays. You bought them, they paid you a nice dividend, and they were your safe harbor in any economic storm. Simple. But then the AI revolution came along, and it was like a lightning bolt hit this sleepy little sector and completely rewrote its story, almost overnight. And this number right here, this is why. The giant data centers that power AI are absolute energy hogs. By 2028, they could be sucking up a staggering 12% of all the electricity in the United States. That's not just a little bump in demand. That's a seismic, once-in-a-generation shock to the system. And the result? Well, get this. The utilities sector is putting up earnings growth of over 23%. That's nearly double the S&P 500 average. These are not your grandpa's utility companies anymore. The so-called safe stock is now acting like a high-octane growth stock. So, okay, if we can't trust the old sector labels anymore, where do you turn for safety? The answer is to start using a smarter, more modern toolkit, one that looks past the industry name and focuses on the fundamental characteristics of what makes a business great. And the most important tool in that new kit is something called the quality factor. It sounds technical, but the idea is actually really simple. You just stop worrying so much if a company is tech or healthcare, and instead you ask 3 questions. Is it highly profitable? Are its earnings stable and growing? And does it have a rock-solid balance sheet with very little debt? Another great tool is to focus on the dividend aristocrats. I love that name. These are the absolute royalty of the stock market. We're talking about S&P 500 companies that have increased their dividend payout for at least 25 years in a row. Think about that. Through recessions, bubbles, and crises, they kept paying their shareholders more. That is a powerful signal of a truly durable business. And you want proof it works? Let's go back to the 2008 financial crisis, an absolute bloodbath. The S&P 500 got crushed, falling 38%. But the dividend aristocrats? They fell by only 22%. That is a huge difference. It's exactly the kind of resilience you want when things go south. Okay, now for a more controversial category, sin stocks. Think tobacco, alcohol, gaming. The reason they're on the list is because demand for what they sell tends to be incredibly stable no matter what the economy is doing. But, and this is a big but, they come with their own baggage. You're always just one new regulation or tax away from some major headline risk. And finally, no modern defensive toolkit is complete without the ultimate alternative hedge, gold. In an era of sticky inflation and geopolitical tension, gold plays that critical role as a store of value. And some analysts are getting really bullish, calling for prices to hit as high as $5,000 an ounce. Okay, we have covered a lot of ground. So let's bring it all home. Let's put this together into a practical game plan. What does the new playbook for building a resilient portfolio actually look like? Here it is, a modern 4-step playbook. First, you build your foundation with a core of those high-quality stocks we talked about. Second, you get targeted exposure to the AI boom, not through the obvious tech names, but through the industrial and infrastructure companies that are the picks and shovels of the revolution. Third, you add that alternative hedge with an allocation to gold. And fourth, you stay nimble, ready to tactically pivot into undervalued areas of the market, like small and mid caps, when the opportunity arises. And that leaves us with one final thought. The investment landscape is changing at an incredible pace. Safe stocks can act like growth stocks, and quality can be found anywhere. So, in a world where the old rules just don't apply anymore, maybe the biggest risk of all is simply failing to adapt.